Okay, let's think about this. When you put your hard-earned money into the market, who's really benefiting the most? Is it you? Or maybe is there something else going on behind the scenes? This deep dive, well, it's kind of your shortcut to understanding how the financial industry actually works, uncovering some perhaps hidden truths about the business of investing.
Exactly. Our mission today is really to pull back that curtain.
Hmm.
Let's take a proper look at who's making the money when you invest. We're digging into some foundational stuff here. John Bogle's Common Sense on Mutual Funds, Benjamin Graham's The Intelligent Investor, the Little Book of Common Sense Investing, those kinds of crucial sources. The goal, to find those surprising facts, those insights that can genuinely help you keep more of your returns, because ultimately your financial future should be in your hands.
Right. And look, this isn't about trying to pick the next hot stock or predict where the market's going next week. It's about understanding the system itself, the incentives, those costs that often fly under the radar, and just the basic structure of the financial industry. It's about getting the business of investing.
Okay, let's dive in. So let's start with something that might actually surprise a lot of people listening. The return the market delivers overall. That's often not what you as an individual investor actually pocket. And the main reason, the biggest culprit, it's like an invisible tax eating away at your gains investment costs.
Yeah, it's interesting, isn't it? Because, returns are always tied to risk. That's a given. But there's this layer of cost that's always there no matter what the market's doing. And if you look specifically at mutual funds, the range of these costs is, well, it's kind of mind-boggling. You could have, say, an aggressively managed small cap fund. Its total charges, operating costs, transaction costs from all that trading might hit 3% a year. But then a simple market index fund, its costs can be down around 0.2%, maybe even less. Wow, okay. 3% versus 0.2%. That's a massive difference, especially year after year.
It's enormous.
Yeah.
And it compounds. That's the killer. So when you add everything up, the all-in cost for a typical stock mutual fund, it can easily reach 2.5% annually. And that's not just the expense ratio they advertise, right? It includes those hidden turnover costs, from the fund buying and selling all the time, maybe 0.5 to 0.8% right there. Plus, if there's a 5% front-end load, that sales charge up front. Spread that over 10 years, and it's another 0.5% a year. These are the things you don't always see immediately.
Okay, so this 2.5% all-in cost, when you add up all those layers, what does that actually do to your returns over time? I mean, 2.5% sounds small, but I get the feeling the impact isn't small at all.
Oh, it's profound. It can be absolutely devastating, actually, that 2.5%. It can gobble up 25% a quarter of a typical 10% market return. And think about the equity premium, that extra bit you expect from stocks over bonds, maybe around 3.5% historically. Well, that 2.5% cost can eat up an incredible 71% of that premium. 71%. Almost three-quarters of the extra return you're taking the risk for could just vanish into costs. And there's more. Things like 12b-1 fees. These are marketing fees paid from your assets, often reducing returns by another whole percentage point. They're used for advertising, basically, to bring in more investors, but they don't actually benefit you, the existing shareholder, one bit.
So wait, these 12b-1 fees, they're paying for ads to get new customers, but the current investors are footing the bill through lower returns. That really does sound like a misalignment. The scale of that erosion is
Yes,
quite something.
it's quite something, precisely. And the sources give a great example to make it really concrete. Imagine you have two portfolios, same stocks, same bonds. One is low cost, maybe 0.2% expenses. It gets you an 8.6% return. The other is high cost, 2.2% expense ratio. Same investments, remember, but it only gives you 7.3%. That difference, 1.3 percentage points, doesn't sound like a lot, maybe, but compound that over 20, 30 years, it's a fortune. Hundreds of thousands, maybe millions, just gone to costs. And that's where it gets really interesting when you look long term.
Okay, so we've established how costs can silently just drain your returns. But, the typical reaction is, okay, fine, but I can just pick a really great fund manager, right?
Yeah.
Someone who can beat the averages and overcome those costs. But our sources kind of throw cold water on that idea, don't they? This whole notion of consistently picking hot funds or star managers.
Right? It's a natural thought. Well, why is chasing those stars often, well, a losing game? It basically boils down to this really fundamental thing in finance called mean reversion,
Hmm.
or as Bogle calls it, the relentless rules of humble arithmetic. It just means that yesterday's winners often become tomorrow's losers. It's really hard to stay on top. Even the best funds, they tend to drift back towards average gross returns. And once you subtract their costs, well, their net returns often end up below average.
So that amazing performance last year, statistically, it's unlikely to repeat, and costs make it even harder. Can you give us a specific example? Why is betting on these superstars so risky?
Yeah, absolutely. The sources are pretty clear. Finding superstars in advance who can stay superstars is incredibly rare, maybe impossible. Think about that cautionary tale of Harold Baxter and Gary Pilgrim's fund. It had amazing early returns, right? Sucked in tons of money. But then, investors lost about 51% of the money. That's likely $3 billion just poof, gone up in smoke. Why? Partly due to risky, rapid-fire trading. And meanwhile, the founders made hundreds of millions from fees and, frankly, questionable trading. It just shows, as the sources say, hot performance by tiny funds should be a warning flag. And beyond that, just getting big is a problem. Size itself makes it harder to beat the market. Gogol puts it bluntly. It's virtually inconceivable that a huge fund owning, say, 21% of the market could consistently outperform. He says the idea that size hurts performance is so obvious that it defies serious debate. Big funds just can't be nimble.
Okay, so if chasing stars is a flawed strategy, what's the smarter alternative? The one the sources keep pointing towards. Something that avoids these traps.
Well, the alternative is often described as this most unlikely hero. It's the index fund. Basically, it's just a broad basket of stocks, passively managed, designed to mirror a market index like the S&P 500. And the key, it's run super cheap, rock-bottom costs. And the evidence, it's pretty overwhelming. The S&P 500 index, for example, has beaten the average actively managed fund by about 1.6 percentage points a year over 25 years. And get this, in the last 15 years, that gap widened to 4.0 percentage points annually. The Wilshire 5000 index beat the average diversified fund by 2.5 points per year. These aren't small numbers. That's real wealth left on the table if you're in the average active fund.
That's a really strong track record. And I gather index funds are also much better when it comes to taxes. That's another hidden cost, right?
Yes, exactly. Big advantage. Index funds are very tax efficient because they don't trade much. They just buy and hold the stocks in the index. Fewer sales mean fewer capital gains taxes passed on to you. Actively managed funds. They're often churning their portfolios. Turnover can be upwards of 80% a year. All that buying and selling triggers capital gains taxes for the investors, even if you haven't sold anything. Just eats away further at your actual take-home return.
It makes so much sense numerically. And what's striking is it's not just academics saying this. Even industry giants, people you'd think would champion active management, seem to agree. You've got Peter Lynch saying most investors would be better off in an index fund. Charles Schwab, admitting only about 1 in 4 active funds beat the market, says that's why I'm a firm believer in the power of indexing. And maybe the most telling, John Fossil, former head of Oppenheimer Funds and active manager, saying people ought to recognize that the average fund can never outperform the market in total. The only flaw, apparently, they are boring. You don't get bragging rights at the barbecue. But, as the sources note, as the years pass, the cost advantage of indexing will keep accruing relentlessly. Maybe boring is good.
Boring can be very profitable. Now let's pivot a bit and look at the industry structure itself. This is really key to understanding the why behind all this. The sources argue, pretty forcefully, that the mutual fund industry has sort of drifted from its core purpose. The focus now seems much more on marketing and gathering assets, rather than just solid portfolio management. And it's not really accidental. It's kind of baked into the business model, which often puts the management company's profits ahead of the investors. And the core conflict you see is that shareholder interests are not being well served. Why? Because the fund directors, who are supposed to represent you, the shareholder, basically hand over all the operations, managing the money, marketing everything, to an external management company. So you, the shareholders, own the fund, but you don't really control it.
Right. So the people whose money it actually is, the shareholders, they don't have much real power over fees or how things are run. That sounds, like a built-in conflict of interest.
It really is. And what happens? These fund boards, instead of pushing back, often just rubber stamp contracts. They tend to go along with steady fee increases, even if the manager isn't doing a great job. It's this ratcheting up process, a bit like, CEO pay in big companies. Fees just keep climbing to these staggering levels, often disconnected from performance. And think about marketing and distribution, getting the funds onto platforms, advertising. Those are highly expensive functions. But who pays? The burden falls on you, the shareholder, through those fees we talked about, not the company promoting the fund. It's like money is no object. To grow assets, using your profits to do it.
Wow. It really does sound like a system set up to benefit the industry first. Are there any fundamentally different ways to structure this, or is this just how investing works?
No, there are alternatives. And they're highlighted in the sources. Warren Buffett, for instance, thinks fund directors could save investors billions, maybe $10 billion, potentially even over $30 billion a year, just by changing how things are governed. And there's a real-world example. Vanguard. It gets mentioned a lot because it has this unique corporate structure. Unlike most firms, the funds themselves actually own the management company. It's not external. This allows Vanguard to operate at costs way below average, about 75% lower, they say. Their average costs are under 0.30% a year, compared to maybe 1.20% for the industry. Why? Because, as Bogle put it, the financial benefits of our success accrue to the fund shareholder rather than to the management company. The incentives are aligned with the investor, not against them.
That's a huge difference. It flips the whole incentive structure on its head, doesn't it?
Mm.
Makes total sense why Bogle believed the main job is just managing the money and everything else is incidental. Cut out the noise.
Exactly. And this structural difference, it impacts what kinds of products get created too. The sources note that many new funds are often of remarkable complexity. Why? Well, maybe not always because investors truly need them. Often it's driven by the industry wanting to fill out their product lines, grab market share, and importantly, make huge profits on new products, which tend to carry higher fees. Innovation for profit, maybe, not always for the investor's benefit.
Okay, let's bring in another giant, Benjamin Graham, the father of value investing. He drew this really sharp line between investing and speculating. Why is that distinction still so vital for us today?
Oh, it's absolutely fundamental. Graham's definition is crystal clear. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Anything else?
Yep.
Operations not meeting these requirements are speculative. He saw things like the 1920s boom, or maybe we could say the dot-com bubble, not as new era investment, but just old-style speculation in disguise. He thought the idea that the desirability of common stock was entirely independent of its price was just incredibly absurd. You can't ignore valuation. And he was pretty skeptical of experts too, wasn't he? Famously asking essentially, why believe the experts now when they were so wrong last time? Plus, he pointed out that just because a company has great growth prospects doesn't automatically mean great investor profits, especially if everyone already knows it and the price is sky high. Finding value is the key.
Right. Think for yourself. Focus on price and safety. Now, we hear a lot about the magic of compounding, how money grows over time. The rule of 72 helps show that, right? But then, how do costs turn that magic into something else?
Yeah, the rule of 72 is a neat trick. Divide 72 by your annual return rate, and that's roughly how many years it takes to double your money. So at 10%, it's about 7.2 years. That's the magic. But then there's the dark side, the tyranny of compounding costs. This is the brutal long-term impact of those fees and taxes we've been talking about. The sources give this really stark example. Let's say the market returns 12%. Sounds good. But after costs and taxes, your actual return of your fund is only 8%. After 25 years, because of that gap, your final pot of money might only be 37% of what you would have had based on the market's raw return. You've lost almost 2/3 of the potential gain. Take it out 40 years, it's even worse. You might only end up with 23%. The tyranny of compounding costs just eats away at the magic.
23%. That is shocking. So much potential wealth just gone. It really highlights that it's not just the market's performance, but what you actually keep. And it underlines the need to distinguish market ups and downs volatility from the real risks you can control, right?
Absolutely. Volatility, prices bouncing around, that's just part of the deal with stocks. It's not necessarily the real risk. The risks you often take, sometimes without realizing it, are things like style risk, betting too heavily on one type of stock, like growth or value that might go out of favor. Or manager risk, picking a manager who just doesn't deliver. Or worse. These are risks you can actually manage, often by choosing broad diversification, like with index funds, and focusing on the one thing you really control: cost. Which brings us back again and again to that simple but incredibly powerful idea: cost matters, perhaps more than almost anything else you can control as an investor.
Okay, so wrapping this up, the big takeaway here seems pretty undeniable, doesn't it? The business of investing, well, it's set up to be very profitable for the industry. Understanding those costs, the incentives, how they chip away at your money, that knowledge is absolutely critical if you want to keep more of your own returns. It's about being smart, being aware, not just crossing your fingers.
Couldn't agree more. And knowing this, it empowers you, right? It lets you make different choices. It highlights the power of keeping things simple, focusing on the long term, and seriously considering low-cost, diversified options like index funds. Because, understanding all this is one thing, but actually applying it to your own decisions, that's where the real value lies.
So the final thought to leave you with is this. What does it really mean for your financial future, knowing that the average fund simply cannot beat the market after costs, and that the evidence showing how much costs matter is just overwhelming? How might you ensure your interests, as the actual owner of the capital, are put first in an industry that often seems focused elsewhere? Something important to think about.